Yeah. Oh, sorry, my connection's gone out.
Oh, you were just
No,
saying that?
joking.
Yeah. Okay. Good. And nobody will ever know what we were just talking about because we're not going to talk about that. So welcome everybody. This is News of the Money World. You're listening to Darcy and Jarrod Kerr, Chief Economist from Kiwibank. Welcome, Jarrod. How are you?
I'm great. Thanks for inviting me along.
No problem. And Rupert Carlan, Kura KiwiSaver. How are you, Rupert?
I'm very well. How are you? Thanks for joining us, Jarrod. It's really exciting to have this conversation.
Cool. All right. Well, should we get stuck into it? And I know you've got a couple of really good questions. We're really, in general, talking about the OCR today and what it means for the New Zealand economy. But Rupert, do you want to go first with some of the questions that you've got stacked up here?
Oh, wow. We'll get straight into it.
Yeah, totally.
Yeah, I guess I'll be honest. So last week, I was kind of shocked at the hawkish nature of that announcement. And for those that didn't hear it, the 75 basis points increase in the OCR, but probably it was the commentary around it which shocked me the most, where we spent a lot of time talking about needing to go faster, harder than had previously been indicated, having a higher terminal rate up at kind of potentially 5.5, I think it was, than expected, and really probably took the market by surprise, as you saw in the movement in the swap rates. And so I think I was surprised. The market was clearly surprised by when you saw what happened with interest rates shortly thereafter. My question really is, what is this kind of, do you think this is a lot of bark and trying to kind of scare the market into behaving? Or is this kind of, do you think there has been a material shift in their inflation expectations over the past kind of month or two?
Yeah, look, you certainly weren't alone. I think just about all of us were expecting a 75 basis point hike on the day, but it was the OCR track which said, hey, look, we've not only have we hiked the cash rate 400 basis points over the last year, but we're going to hike another 125 to 5.5%. That surprised us. That was a lot more assertive than we had thought. You have a central bank, like most central banks around the world, 90 central banks have been lifting interest rates to fight inflation. But you have a central bank in New Zealand who are really quite concerned about the uplift in domestically generated inflation. That's the hardest stuff to tame. That's the hardest stuff to get on top of. And they think they have to come out the way they did. It was a decision not only to hike 75 basis points but to be really hawkish and really hammer home the message that they're just going to keep lifting interest rates until they see inflation trending back down towards 2%. Your question around bark versus bite, I think is a good one, and I always think of it as they bark first and then they bite later. They have been barking, and they're clearly barking again, but you can only do that for so long without following through. And like I said, if we wake up in 6 months' time and domestically generated inflation is still tracking higher, the economy is still acting the way it is and well above where supply can clear, that they will bite again. So this is a central bank which is very much on the front foot. They were one of the first central banks to start hiking. Then other central banks like the Fed and that's sort of started catching up, and now they've decided to get clear of the pack again and be one of the most aggressive central banks on the planet.
And I find that quite interesting, right? Because one of the big questions in my mind is that second part of it, right, where we're starting to see out of some of the other reserve banks around the world, RBA, definitely kind of toning back a bit. There is an expectation, yet to be proven whether this comes out correct or not, that the Fed in a couple of weeks will kind of give people some clarity around where this all ends and start slowing things down. So kind of that's the other bit that I find really interesting, is we are getting more aggressive at a time when people are starting to calm down. But I also note what you said, which was we've kind of always, for the last 2 years, we've probably been 3 to 6 months ahead of the rest of the world. is this, so I guess two questions in that. One is, why are we so different? And why are we doing it differently? And second question is, can you read this into being potentially, this might be an indicator of where others are going to need to go in 3 to 6 months' time when they get their heads in the same space?
Yeah, potentially. That is what I guess we've seen in recent times, right? Central banks have come out. They've come out strong in their minds, and then they've been surprised, again on the high side with inflation. So the war on inflation is far from over. Although I do tend to side more with the Fed and others in thinking that the massive amount of tightening, the huge lift in interest rates that we've seen so far is having an impact now. It's feeding through now, and it's going to have, I think, a material impact on households. We are going to see a number of households coming under significant stress, so that should see consumption come off. Yeah. So yeah, I mean, I think it's a timing thing. I do believe that with the significant slowdown in global growth that we've got coming through, that will lead to lower commodity prices, that will lead to lower inflation coming in from offshore. We've been importing half of our inflation from offshore. The other half has been domestically generated. I think, the central bank actually risks doing too much by tightening to 5.5. We think they only need to go to around sort of 5% or even lower, given the amount of pass through that's happening right now. So we're at odds with the RBNZ, but to your point around barking versus biting, I think they've just decided to go hard and deliver a very, very firm message. And if that doesn't work, they'll be, disappointed and having to do more later on. Or if it does work, well, great. They don't have to tighten all the way to 5.5% like we think. We think they won't get there. But there's going to be a lot of carnage on what I think is already being delivered.
Is the New Zealand situation worse than what's happening internationally? Because that's kind of the headline numbers in New Zealand are similar, slightly lower. We do seem to have a tighter labour market. But, I mean, that's the other piece that I can't get my head around is, how different is our situation versus internationally, particularly when you go, I mean, we've got worse supply chain issues because the shipping lines have kind of given up on New Zealand. But, still that 50%. So, I'm just really trying to still unpick that New Zealand versus the rest of the world piece.
Yeah. We have a lot of very similar problems around the world. We're all sort of facing into very high inflation because, most central banks, I'd say just about all central banks, overstimulated during COVID. And now we're sort of mopping that up, and we're mopping up, very high inflation rates. So we're all sort of fighting the same beast at the same time. And labour markets are proving to be very tight around the world as well. Wherever you look, it could be the US, it could be Australia, it could be large parts of Europe. There are difficulties on the supply side, particularly around labour, and I think that also contributed to the outflow of Kiwis that we saw earlier in the year. Is New Zealand better off or worse off? I'd say, generally speaking, we're better off than a lot of economies around the world. And that's obviously feeding into the Reserve Bank's thought process, that they are worried that a lot of the inflation that we're generating out of the housing market and in construction in particular is just going to keep grinding higher next year. So they're doing what they can to get inflation back down. They are failing on their mandate, which is a big thing. Not only are they failing on it for a few months, they're actually projected to fail on it for a very long time. So you can go one step further, and it's not just the RBNZ, but you can go one step further and say, hey, look, your credibility as an inflation fighter is being questioned here, particularly when you look at inflation expectations, which don't have inflation returning to the 1 to 3% band, let alone 2% for many a year. and that really is a strong signal to the Reserve Bank, and something which I know has them quite concerned. We're going to have a period of about a year with inflation running above 7%. What does that do to inflation expectations over the medium term? I think they're worried it lifts them.
Totally. So if I may tilt this chat now more towards the property side of things, I am just kind of looking at the OCR now. Clearly, it's at levels not seen since 2008. And I wonder if, and maybe my thinking isn't quite right here, but I just wonder if, assuming the interest rates stay where they're at right now and fixed interest rates adjust, which they seem to be doing right now with the main banks, am I correct in assuming that given a long enough time frame, house prices will eventually revert back to the levels that we saw in 2008? I know that's quite extreme, because that's extreme. But is that technically possible, that if we have the rates, we also have the house prices?
Well, I mean, things are possible for sure. You never rule out anything, but I'd say it's a very low probability. We saw a global financial crisis which had a huge impact on financial markets and funding markets, and that really hurt banks at the time. Trust in the system really was questioned, and we saw a much greater impact, I think, than what we're going to see from a self-inflicted rate rise scenario cooling the housing market down. I think our forecasts are kind of coming out roughly in line with what's happening. House prices are down around 11% at the moment. They look like they'll be down around 13% on the year, which is actually bang on our forecast. But now we're thinking that the declines continue a little more into 2023, and we see a correction of around 20%. It sounds like a lot, but we mustn't forget the couple of years of extraordinary house price growth we had, leading into 2021, 2000 and earlier this year. So, house prices, they rose 30-odd% in the year to August last year, which is extraordinary. So, in terms of levels, we're coming back down for sure, but I think we're unlikely to drop, of that magnitude. And again, I think interest rates should peak in the next 6 months, and I think we'll see interest rates coming off towards the back end of next year, and we're actually forecasting the housing market recovering from the middle of next year into 2024. And that's going to be fueled by the fact that interest rates aren't rising anymore, and actually look like they'll start falling in the second half of next year. A return of migration, which we're seeing now, and just a better balanced housing market, over the medium term.
Cool. Okay. There's definitely quite a bit to unpack there, but let's go back to what you said around so house prices around 13% is what things have gone down by. You're kind of thinking maybe around that 20% mark is probably what we might see. And so I guess it's kind of like the accelerator and the brake pedal, right? The longer you push it, and it's inevitable that you'll come to a stop eventually, but it can slow things down. So the settings with interest rates will slow things down, will bring prices down, but presumably the Reserve Bank will be able to, and they'll be justified in taking their foot off the brake so aggressively. But thinking about the people that have only just bought in the last couple of years, now that we've seen this wash off where there's about 13% off average house prices, some of these people would have been low deposit borrowers and thinking that this is the best thing ever. Interest rates have never been this cheap. Property only goes up in value. Shortages everywhere. There's a housing crisis that they were led to believe would always persist. And so if they didn't get in now, they would never get in. And now that they're in, it's not looking so good. Are you seeing any evidence to suggest that there's an increase in arrears, defaults, potentially even mortgagee sales?
Not yet, believe it or not yet. It doesn't mean it won't happen, but we're not seeing that as a bank yet, which is good. And you know, we must say that the labour market here is incredibly tight. You know, most people who want a job can go out and get one. We're seeing a significant lift in wages, so income growth is picking up for households. But unfortunately, at the same time, you've had this cost of living crisis and now rapid rise in interest rates. So there is a bit of a, you know, give with one hand, take twice as much with the other. In terms of, you know, buying a house last year and all of a sudden you're in negative equity potentially, and you're facing much higher interest rates, you know, we have a lot of sympathy for that. Personally, I have a lot of sympathy for that. I purchased my first house in 2007, exactly a year before the global financial crisis. So I know exactly what people feel when your house price isn't worth what you paid for it and you're in negative equity. And just to confirm my brilliant ability to pick the market, I also bought an investment property in 2016 in Australia, and house prices fell straight after doing that as well, which was to do with their supply and demand dynamics. Yeah, so if you want to know what's going on, probably do the exact opposite to what I'm doing personally.
Yeah, says the Economist at Kiwibank. Yeah, that's good.
That's right.
Put you on that.
Hey, and so on the housing then, final one from me on that one. So does that mean the 20%, just having a quick look at the numbers, does that mean that brings household income to house prices back to kind of that long run average of around 6 times, does it?
I'm not sure it does. I'm not sure it goes that far, but it'll definitely move in the right direction. I think we're about 10, 11 times, I think, off the top of my head. So it would take. It certainly moves in the right direction for sure. So you know, what would be great is if income growth sort of stabilized, and you know, we got nice sort of 3 to 5%, you know, wage gains each year type stuff, and house prices, you know, they grew at a modest rate, sort of balancing that out a bit. And I think some of the good news in the housing market is the fact that we have seen quite a surge in supply. So that is going to be helpful going forward, because the New Zealand market is clearly unaffordable, even after these declines that we've had, and you know, very difficult for people to get into. So yeah, I think what we're going through is a correction for previous excesses, following the massive amount of stimulus delivered over the pandemic. But what we'd like to see going forward is a much more better balanced housing market with a lot more supply of affordable homes, and we're a long way away from that, but we're at least moving in the right direction.
Yeah. Are you kind of suggesting that politicians might want to plan in advance and think about infrastructure and housing and kind of matching the country to kind of population growth?
Yeah, it is a constant frustration of many economists, including myself. We've been banging the table about this for years, and it goes well before COVID, and it's not just one government. It's
all government.
Over decades, right? And we were really found out between 2014 2019, when we had the largest migration boom this country's recorded, you know, going back since data began in the 1800s. And you know, we simply didn't increase the investment in key infrastructure, like you say, and we simply didn't, I guess, encourage enough supply of housing. And when you let people in the way we did, you get a nice supply side response in the labour market. You've got more people to employ, fantastic, but you get a huge demand shock as well, because there's more people, you need more housing, you need more healthcare, education, or all of the above, and we're simply not that good at responding to those changes in population.
I mean, one of my big things, my big gripe on the New Zealand economy over the last probably 15 years is it's fundamentally been driven by supply growth, right? Increased people, increased use of natural resources, whether that be water or dairy, etc. And we actually haven't had a very good economy. We've just thrown more people at it, and haven't been able to achieve any productivity growth at all.
Yeah, and that's a common, that's very well debated and looked at by just about every economist around. We've had declining productivity, as you say. That's a one measure of well-being, for example, and how well we're doing, and we have performed terribly on that front. It is a little hard measuring during times of extreme increases in population the way that we have, but the point is we simply haven't invested over the decades to match the population growth that we've had, and I think no one's going to debate that. Most people are out there saying we need to do more across the board, right? It's a failing, which is sad and embarrassing, I think, as a nation.
Well, yes. So the flip side, the slightly better news is that we're, from my reading at least, we're not the only ones that have fallen into this trap, right? At least we're not living in the UK where productivity has gone backwards, fallen like a stone. Even the US, they haven't had much. The productivity has been driven by outsourcing rather than actually improving processes and creating more wealth onshore. We're not alone in terms of this issue, but I think we've got an overly flattering view on the past 10, 15 years when you look at it through that lens.
Yeah, you're right. And I think it's quite exciting as to what's going to happen in the future, because there are a lot of things happening, as we become more digital, as we 3D printers, all of these really cool developments, and maybe we start doing a little bit more of our stuff onshore rather than offshore, like you say. I think it's going to be quite an exciting period for economic growth over the next decade, just with the advances in technology that we're seeing.
Well, and also where you've got the end of the cheap labour era, right? Because again, another one of my theories, the last 40 years and will be kind of looked at as the era of cheap labour, whether it was kind of domestic immigration, whether it was cheap offshore labour, where you had China coming into the global workflow force, etc. And there is nothing like need, and those days are over. And now companies are just going to have to innovate. Otherwise, they're not going to be able to drive growth, because they're not going to be able to just go to cheap labour anymore.
Yeah, and that also feeds into the deglobalization thoughts as well, right? I agree with you. I don't think we can overestimate, just how much China has influenced the world in recent decades. Yeah, you're absolutely right.
Hey, a great question from Shannon on stagflation, and I'll be honest, last Thursday or Wednesday, or whatever that was the first thing that came into my head. Reserve Bank was almost predicting stagflation. What's your view on the risk of stagflation, where we sit now, and is it unavoidable, or can we still avoid it?
We're going to go into a year which is going to feel very stagflationary. We are going to have very low growth rates globally. A lot of the world is going to be falling into recession next year. You just need to look at IMF and World Bank and other forecasters out there, which have very, very weak global growth outlooks for next year, with nothing but downside risks. And then obviously that feeding into New Zealand and the Reserve Bank here forecasting a really long, not deep, but long recession of 4 quarters, and then a couple of quarters of nothing after that. So 6 quarters of really ordinary outcome. So the growth side of things is going to feel very, very weak, if not recessionary. And then on top of that, prices are still stubborn and persistent. So it is going to feel a bit stagflationary, but central banks have learnt from the 80s and the 70s, and this is why 90 of them globally are working hard to break the back of inflation, and I think that they will be successful, just given the size and speed at which central banks are moving at the moment. Suggests that we are going to get, I think, a significant slowdown and actually get on top of the inflation beast next year.
But if it's driven by, I mean, this is the challenge to me in my mind. I've got a pessimistic one-track mind though. But if we're in a world of like labour global problem, immigration, we're going to struggle to attract people to this country because we're a low-wage country. So no matter, they could open the doors up, and with kind of what we're talking about, it's going to struggle. So yeah, does the supply side actually, the demand side, it's going to have to shrink a long way to match the supply side, isn't it?
Yeah, that's exactly what they're trying to achieve. We do still have frustrations on that is the theory, yeah, bang on. We do have frustrations on the supply side, as you say. Global supply chains are far better than they once were. The delivery times are much faster. Shipping costs are down a lot. So they have improved, but they're nowhere near as efficient as they once were. So a lot of businesses that we speak to have gone from a just-in-time inventory management to a just-in-case. They're holding a lot more inventory, which costs more across the across their supply chains. But yeah, it is a world where you're right, that they are just focused on getting demand down to better clear and reduce those inflationary pressures. I had something else I was going to say, but I've forgotten. Sorry.
That's right. We'll just make it up. We'll just make it up.
Right. Just insert something.
we'll just cut to something else, pre-prepared just in case. So I want to bring it back to mortgage rates, property banking, just because I've heard this comment in the media a couple times. Well, funnily enough, since the OCR increase, and it's kind of the same sort of thing with petrol prices. When you see the cost of fuel going up, one of the natural assumptions is to think that we're being just price gouged, right? And with interest rates now going up significantly, the natural assumption is that the banks are just being greedy. And maybe there's some truth in that. So I just want to kind of understand some of the mechanics behind this, because when interest rates are low, obviously getting closer and closer to zero, I would have just imagined that banks' margins naturally get compressed the lower you go with interest rates. So the opposite of that would also be true. The higher interest rates get, is that correct in that there's more margin for banks, and therefore it would be a natural outcome that banks would have to be profitable in a rising interest rate environment?
We hold assets, and the assets that we hold attract an interest rate. So clearly, the higher interest rates are, the more interest we're earning on the assets that we hold. But in terms of the interest rate that most people see, banks just they offer an interest rate for a term deposit, and then they offer an interest rate for a mortgage, and it's about that difference that you're talking about, the margin between the two, and obviously we're taking money in as term deposits for a short period of time. People give us term deposits for 1, 2, maybe 3 years, and then we're lending that out for 25, 30 years. So we're managing what we call the curve risk We're lending for a very long period of time. We're taking in money for a short period of time. We need to keep those term deposits ticking over in order to fund that 30-year loan. So it does come down to just the margin and whether that margin increases or decreases over time. I think what we are going to see into next year, and I may be wrong, but what we're going to see into next year is potentially bank margins coming under pressure next year, believe it or not. The funding for lending program has come to an end. That was a very attractive, cheap source of funding for us for a period. I think we may find ourselves fighting a little bit more over term deposits, so therefore, increasing the rates on term deposits relative to the cash rate. I think that funding mix that we have is going to become a bit more expensive. Can we pass that on? Well, we're in a world where demand for credit, demand for loans and mortgages is coming off. The housing market's quite soft, so it's going to be there's going to be competitive pressure, I think, there to fight for what we can in a slowing housing market. So the actual level of an interest rate outside the assets that we hold, the level of an interest rate set by the Reserve Bank, and then we're really talking about what's happening with our margins. I think we may actually see that bank margins come under pressure next year.
That would be interesting. Hey, just really quickly before we go, this really interesting question has just come through, and I know we're a little bit over time, but we'll make it quick. Ihaka Harty, hopefully I got that right. Just a question in regards to your comment about the end of cheap labor. Is it possible Africa could fill in that space in the future? China has been using Africa for cheap manufacturing, etc. So yeah, is it possible that some of the cheap labor that we used to access, partly from immigration, is it possible that could shift and we could see the doors opening up to more African people? I guess that's kind of maybe where she's coming from there. What do you think?
The answer is yes. Is it the same as China? No. Just sheer fact that China's got what is it, 1.75 billion people? Yeah. And you look at Africa, there's a fair amount of people in Africa, but you don't quite have that same dynamic that with the opening up of China. India for me is the big country that we need to be thinking about over the next decade. India is doing a lot. They're growing. They're doing really well in a lot of their reforms. India is the country that I'm focused on, and I really hope that our officials, and I know they've been working on it for a long time, but I really hope that our officials can get out there and get a free trade agreement of some description with India as soon as possible. We need to get them as our second largest or even largest trading partner over the next decade, because that's where I think a lot of growth is going to come from, potentially a source of cheaper labor as well. And we all know how good they are in tech space already.
Yeah, that's awesome. Okay, Rupert, any parting questions before we finish up?
No, that was awesome. That was fascinating. A lot to think about.
Definitely. Thank you very much, Jarrod. Really appreciate your time. Chief Economist with Kiwibank. Thanks for hanging out with us tonight.
Thanks for having me. Great chat.
No worries.
Thanks, Jarrod.